In 1923, Germany experienced hyperinflation so severe that a loaf of bread cost 200 billion marks. People who held cash in the bank lost everything. Their life savings became worthless overnight. But those who owned one specific asset became millionaires while their neighbors starved. Fast forward to 1929, the Great Depression. Stocks crashed 89%. Millionaires jumped from buildings, but holders of another asset saw their wealth double while the world burned. Argentina 2001, banks froze accounts. People rioted in the streets. Savings vanished, but real estate owners stayed wealthy. 2008, Lehman Brothers collapsed. The global financial system nearly died. But three specific assets not only survived, they thrived. There's a pattern, and understanding it could save everything you own. Before we test these assets, you need to understand something critical. Not all economic collapses are the same. The asset that saves you during inflation will destroy you during deflation. The strategy that works in a banking crisis fails completely during a currency collapse. Over the last 95 years, we've seen four distinct types of economic disaster, each with completely different rules. Type 1. Hyperinflation collapse. Weimar Germany, 1923. The government prints money to pay debts. The currency becomes worthless. A wheelbarrow of cash buys one loaf of bread. Type 2. Deflation collapse. The Great Depression, 1929 to 1933. Credit disappears. Businesses fail. Asset prices crash 90%. Suddenly cash is the only thing that matters. Type 3. Currency collapse with banking freeze. Argentina 2001, the government defaults on its debt. Banks freeze all accounts. The peso loses 75% of its value in months. People can't access their own money. Type 4. Banking crisis with monetary expansion. The 2008 global financial crisis. Lehman Brothers fails. Credit markets freeze. Stock markets crash 50%. Then governments print trillions to bail out the system. Four completely different scenarios. Four completely different outcomes for your wealth. So we're going to test 7 major asset classes across all 4 real historical collapses. Cash and bank deposits. Government bonds. Stocks and equities. Real estate. Precious metals. Gold and silver. Foreign currencies and foreign assets. And productive assets like businesses and farmland. 7 assets. 4 collapses. 95 years of data. Let's see what actually survived. Let's start with what most people consider the safest asset. Cash in the bank. Test 1. Weimar Germany 1923. Hyperinflation. If you held 100,000 marks in January 1923, by November it wouldn't buy a postage stamp. German banks stayed open. Your deposits were accessible. But the money itself became worthless. People who kept cash lost 100% of their purchasing power in 10 months. Total destruction. Test 2. Great Depression. 1929 to 1933. Deflation. Here cash was king, but only if your bank survived. 9,000 banks failed. If your bank went under, your deposits vanished. No FDIC insurance existed yet. But if your bank survived, your cash gained massive purchasing power. Prices dropped 25%. Your dollar bought more in 1933 than in 1929. Cash holders who picked the right bank won big. Test 3. Argentina 2001. Currency collapse. The government froze bank accounts. The Corralito, you couldn't withdraw your own money. When accounts finally reopened, the peso had devalued 75%. Your $10,000 in peso deposits became worth $2,500, and initially you couldn't access it at all. Partial destruction. Test YPA financial crisis. US banks faced runs, but FDIC insurance protected deposits up to $250,000. Your cash was safe in nominal terms. However, the Fed printed trillions. The dollar lost purchasing power. Not catastrophic, but erosion of maybe 15 to 20% over the following years through inflation. Verdict on cash. Dangerous in 3 out of 4 scenarios. In hyperinflation, total wipeout. In currency collapse, partial wipeout. In deflation, excellent, but only if you picked a surviving bank. In banking crisis with government response, slow erosion, cash is not the safe haven people think it is. Your money in the bank is a government IOU. When governments fail, or when they print, that IOU loses value fast. The only time cash wins is deflation, and that's the rarest type of collapse. Cash and bank deposits fail the survival test in most scenarios. Asset number 2. Government bonds, treasury bonds, sovereign debt, the supposedly risk-free asset. Test 1. Weimar Germany 1923. German government bonds were denominated in marks. When the mark hyperinflated, bond values collapsed. If you owned 100,000 marks in German bonds in January 1923, by December they were worthless. Bondholders lost everything. Total wipeout. Test 2. Great Depression. 1929 to 1933. US Treasury bonds actually performed well. While stocks crashed 89%, Treasury bonds held value and even gained as interest rates dropped. Government bonds were one of the few safe places. Clear win for bonds. Test 3. Argentina 2001. The Argentine government defaulted on $82 billion in sovereign debt. Bondholders received 30 cents on the dollar after years of legal battles. If you owned $100,000 in Argentine bonds, you eventually got back $30,000. 70% loss. Catastrophic. Test Y. PA financial crisis. U.S. Treasuries were the safe haven. Everyone fled to Treasuries. Bond prices rose, yields dropped. Treasury holders made money while stocks crashed. Another win. Verdict on government bonds. It depends entirely on which government. U.S. Treasuries survived both the Depression and 2008 because the U.S. didn't default, but German bonds in Weimar and Argentine bonds in 2001 were completely destroyed because those governments failed. The key insight: government bonds are only as safe as the government issuing them. When the government is collapsing, their bonds collapse too. Right now, the U.S. has $38 trillion in debt, deficits over $2 trillion annually, and mandatory spending that exceeds revenue. The question isn't whether U.S. Treasuries are safe today. The question is whether they'll be safe at Stage 5, Stage 6, and Stage 7 of collapse. History says probably not. Asset 3. Stocks and equities. Ownership in businesses. Test 1. Weimar Germany, 1923. This is fascinating. The German stock market exploded upward during hyperinflation. Stocks were real assets, ownership in actual companies with factories, inventory, real things. As the mark collapsed, stock prices in mark terms went vertical. If you owned stocks, you preserved wealth. But timing mattered. You had to sell at the right moment and convert to foreign currency or hard assets. Stocks protected you, but weren't a perfect solution. Test 2. Great Depression, 1929 to 1933. Catastrophic destruction. The Dow Jones dropped 89% peak to trough. $100,000 in stocks in 1929 became $11,000 by 1933. Companies went bankrupt. Dividends stopped. Stocks were obliterated in deflation. If you held through the crash, you eventually recovered, but it took 25 years to get back to 1929 levels. Most people sold at the bottom and never recovered. Devastating loss. Test 3. Argentina 2001. The Argentine stock market crashed 50% in dollar terms, even more in peso terms. Companies tied to the domestic economy were destroyed, but companies with export businesses or dollar revenues survived better. Mixed results. Significant losses. Test Y. PA financial crisis. U.S. stocks dropped 57% from peak to trough. The S&P 500 went from 1,565 in October 2007 to 676 in March 2009. Brutal losses. But if you held on, stocks recovered by 2013 and then soared. Long-term holders eventually won, but you needed stomach and time. Verdict on stocks: extremely volatile and scenario dependent. In hyperinflation, stocks can protect wealth if held in real assets and foreign-focused companies. In deflation, complete disaster. In currency collapse, mixed. In banking crisis with recovery, eventual win if you can hold through the pain. Stocks are not safe during collapse. They're a long-term recovery play if you can survive the drawdown. Most people can't. A set for real estate, land and property, the tangible asset everyone thinks is safe. But here's the critical distinction. Paid-off real estate versus mortgaged real estate. Completely different outcomes. Test 1. Weimar Germany, 1923. If you owned property outright, you survived. Real estate held value because it's a real asset. Land, buildings, actual things. But if you had a mortgage, you won spectacularly. Hyperinflation destroyed the debt. If you owed 100,000 marks in 1922, by 1923 that debt could be paid off with pocket change. Mortgaged property owners became essentially debt-free overnight. Massive win. Test 2. Great Depression, 1929 to 1933. Real estate prices crashed 25 to 30%. Property values collapsed with everything else. If you owned property outright, you lost value but kept the asset. But if you had a mortgage and couldn't make payments, the bank foreclosed. You lost everything. Mortgaged property was catastrophic unless you had cash flow to service the debt. Millions lost their homes. Paid-off property survived. Mortgaged property often didn't. Test 3. Argentina 2001. Property held value relatively well, especially in Buenos Aires. Real estate priced in dollars maintained worth. Argentines who owned property outright stayed wealthy while their neighbors' bank accounts were frozen and devalued. But mortgages were complicated. Some were in pesos, some in dollars. Peso mortgages became easier to pay. Dollar mortgages became impossible. Mixed outcomes. Test Y. PA financial crisis. Housing prices dropped 30 to 40% in the US. Millions of foreclosures. If you were over-leveraged, you were destroyed. Entire neighborhoods abandoned. But if you owned property outright or had sustainable debt levels, you survived. Property eventually recovered. By 2020, real estate had regained value and more. Verdict on real estate: it depends entirely on leverage. Paid-off property survives almost everything. It's a real asset, a tangible thing. Mortgaged property can be spectacular in hyperinflation, but catastrophic in deflation or banking crisis if you can't make payments. The lesson: own property outright, or at least have very sustainable debt levels. Over-leveraged real estate is a massive risk during collapse. Asset 5. Precious metals, gold and silver, the oldest stores of value in human history. Test 1. Weimar Germany. Gold was illegal to own for German citizens in many forms, but those who held it anyway or who held foreign gold-backed currencies preserved wealth completely. While the mark collapsed, gold held steady international value. An ounce of gold bought the same amount of real goods in 1923 as in 1920. Perfect preservation of purchasing power. Test 2. Great Depression, 1929 to 1933. Gold was fixed at $20.67 per ounce, then revalued to $35 per ounce in 1934. Holders of gold saw a 69% gain overnight when Roosevelt revalued, but owning gold was made illegal for U.S. citizens in 1933. The government confiscated gold, paying $20.67, then immediately revalued it to $35, making a massive profit while citizens lost out. Still, those who held gold internationally or hid it domestically preserved wealth. Partial win with complications. Test 3. Argentina 2001. Gold and silver weren't commonly held by Argentine citizens, but those who owned precious metals maintained wealth. As the peso collapsed, gold's value in peso terms soared. Complete protection. Test Y. PA financial crisis. Gold started 2008 at $869 per ounce. By 2011, it hit $1,900, more than doubled while stocks crashed and recovered. Silver went from $14 to $48. Precious metals soared as central banks printed money. Clear win. Verdict on gold and silver: they work. Across all 4 collapses, precious metals either preserved wealth or gained value. The only complication is government confiscation, which happened in the US during the Depression. But even with that risk, gold and silver are proven stores of value during collapse. They passed the survival test better than almost anything else. Physical metals, not ETFs or paper gold. The real thing. Asset 6. Foreign currencies and foreign assets, diversification outside your collapsing country. Test 1. Weimar Germany, 1923. Germans who held US dollars, Swiss francs or British pounds were completely protected. While the mark became worthless, foreign currencies held value. Those who moved money outside Germany before the collapse stayed wealthy. Those who didn't lost everything. Foreign currency was the ultimate escape valve. Total win. Test 2. Great Depression, 1929 to 1933. This was a global collapse. Most currencies suffered, but it was primarily a US and European crisis. Countries like Australia and some South American nations were less affected. Diversification helped, but there weren't many safe places. Partial benefit. Test 3. Argentina 2001. This is the perfect example. Argentines who held US dollars were protected. While peso bank accounts were frozen and devalued, dollar accounts maintained value. Those who had moved money offshore, to Uruguay or the US, were untouched. US dollars saved Argentine savers completely. Massive win for foreign currency and assets. Test Y. PA financial crisis. This was a global banking crisis. Most currencies dropped against gold, but the Swiss franc and gold itself were safe havens. Moving assets to Switzerland or Norway or Singapore helped. Diversification reduced losses, though nowhere was completely safe. Partial win. Verdict on foreign currencies and assets: extremely effective in country-specific collapses like Weimar and Argentina. Less effective in global crises like the Depression in 2008. The key is diversification before the collapse. Once capital controls hit, once banks freeze, it's too late. You need foreign accounts, foreign property, foreign currency holdings established ahead of time. Right now, with the US at stage 4 and the dollar as the global reserve currency, the question is, where do you diversify to? What currency is safe when the reserve currency fails? That's the trillion-dollar question. Asset 7. Productive assets, operating businesses, farmland, things that produce value. Test 1. Weimar Germany, 1923. Businesses that produced real goods and accepted payment in kind or foreign currency thrived. Farmers with land and crops were wealthy. They had food, the ultimate currency. Industrial companies with export capability made fortunes. Productive assets dominated. If you owned a factory making products people needed, you survived and prospered. Clear win. Test 2. Great Depression, 1929 to 1933. Many businesses failed. Demand collapsed. Factories shut down. But businesses producing necessities, food, basic goods, survived. Farmland maintained value better than stocks or urban real estate. People always need to eat. Productive farmland was a survivor, though not a winner. Partial success. Test 3. Argentina 2001. Agricultural businesses, farms producing soybeans and beef for export, did well. They earned dollars selling abroad while costs were in devalued pesos. Export businesses won big. Domestic-focused businesses suffered, but productive assets, especially those earning foreign currency, were excellent. Win for the right kind of productive assets. Test why. PA financial crisis. Some businesses failed. Lehman, Bear Stearns, gone. But well-run businesses with low debt survived and eventually thrived. Farmland held value. Productive assets with real cash flow and low leverage came through. Technology companies with strong balance sheets like Apple and Google eventually soared. Mixed results, but quality productive assets survived. Verdict on productive assets: they work if they're the right kind. Businesses producing necessities, farmland, export-focused operations, these survive. But leveraged businesses, or those dependent on consumer discretionary spending, can fail. The key is productive assets that generate real value, necessities, food, essential goods, and low debt levels. Productive assets pass the test, but you need to choose carefully. Now let's apply this to where the United States stands today. As we covered in the previous video, the US is at stage 4 of the 7-stage collapse pattern. Social Security's trust fund depletes in 2033. That's 7 years away. The national debt is $38 trillion and growing by $2 trillion per year. We're printing money while running massive deficits. Based on the historical pattern, here's what's likely coming. Stage 4 continues for the next 5 to 7 years. This is where we are now. The system still functions, but stress is building. During this phase, the survival strategy is minimize cash and bank deposits. Keep only what you need for 6 to 12 months of expenses. Cash will lose purchasing power as printing continues. Avoid long-term government bonds. Short-term T-bills are okay for liquidity, but long-term treasuries are a risk when debt is unsustainable. Hold some stocks, but focus on companies with foreign revenue, hard assets and low debt. Avoid companies dependent on government spending or consumer discretionary spending. Own real estate if it's paid off or has very low leverage. Your primary residence owned outright as protection. Investment properties with sustainable debt can work. Over-leveraged property is dangerous. Hold precious metals, physical gold and silver. This is your insurance policy. 10 to 20% of assets in physical metals stored securely. Diversify internationally if possible. Foreign currency accounts, foreign property, foreign investments. Not easy for most Americans, but critical for those with significant assets. Consider productive assets, a business generating real cash flow, farmland, things that produce value regardless of currency. That's stage 4 positioning. But what about stage 5 and beyond? Stage 5, partial collapse, pension cuts, benefit reductions, social unrest. At this point, precious metals become even more critical. Foreign assets essential, cash increasingly dangerous. Stage 6, currency crisis. The dollar loses reserve status. International trust collapses. Here, foreign currencies and hard assets are the only survivors. Dollar-denominated anything is catastrophic. Stage 7, system replacement. New currency, new government structure, possibly new country boundaries. At this stage, survival is about physical assets, food, land, community. Financial assets are secondary to tangible assets. We're at stage 4. The window to prepare is now, not later. Later is stage 5, and your options become much more limited. I've created a complete asset survival matrix that shows all 7 asset classes, their performance in all 4 collapse types, specific allocation recommendations for stage 4, stage 5, and stage 6, and detailed action plans you can implement right now. It's 70+ pages based on 2,000 years of collapse data, not theory, but actual historical outcomes from Weimar, the Depression, Argentina, 2008, and more. Link in the description, and subscribe, because in the next video, we're ranking 30 countries by collapse stage. Where does your country stand? Is it ahead of the US? Behind the US? Which countries are safe? And which are approaching stage 5? You need to know this before it's too late, because stage 4 doesn't last forever. Eventually it becomes stage 5, and once that happens, your options to protect yourself shrink dramatically. The historical pattern is clear. The math is clear. The only question is timing. Don't wait until stage 5 to prepare. Do it now while you still can.